Hello guys, welcome back to this video. What we are going to discuss today is the ICT trading styles. So I'm going to give you an overview of what ICT trading styles entail, and then I'm going to give you key concepts of ICT that you need to know if you want to become an ICT trader. So just a brief introduction. I think you've seen this logo online on many YouTube videos, and this is the person behind it. And a colored one I've seen somewhere here. This could be the person who is the ICT trader himself. So basically, let me give you a brief introduction of what ICT trading entails. So ICT trading style refers to the inner circle traders approach, a methodology developed by a trader named Michael J. Huddleston, who is also known as the inner circle trader, or just ICT. Now, ICT trading focuses primarily on technical analysis and market structure, and it emphasizes understanding of how institutional traders operate. The goal of ICT is to align trading strategies with the actions of the big market players, the big banks. Now let's go to the key concepts of ICT. So the first key concept of ICT that you need to learn or you need to know is called market structure. This is the core of ICT trading style. Every ICT trader knows market structure. So if you are an aspiring ICT trader, you must know what market structure entails. Now, market structure just involves understanding the overall trend in the market by identifying highs and lows of the market, as you can see in this example. So ICT traders look for changes in the market direction to decide on buying or selling opportunities. Now, in market structure, you will come across terms called break of structure and change of character, or probably you've heard about them. So when the market breaks a previous high or low, it indicates a possible shift in trend. As you can see here, we have it was pulling and then it broke this structure, pulled, broke this structure, pulled, broke this structure. So it is all about breaking the highs and lows. As you can see this example, on a downtrend it is also the same, just breaking the lows of the previous structures, as you can see here, and then the highs back again. So that is basically what happens when market breaks previous high or low. ICT traders call it change of character. Now call it break of structure. Now there's another concept in market structure called change of character, or COH, or some people call it market structure shift, this B option. So basically this refers to a significant change in market structure that signals a reversal of trend. Now if you look at this trend that I've shown you, this is the ideal market condition. This is what you're going to face on the market, not the normal things you see of high, low, high, low, high, low. This is the reality of the market, and this is just a tip of the iceberg on it. So when you see market moving from highs, breaking highs like this, breaking highs, breaking this high, then breaks another high, and then all of a sudden it breaks the low that made the break of the high. That one is what is referred to as change of character. Some people still refers to it as inducement, and then the next one here becomes change of character. It squarely depends on your trading style, and therefore any is still suitable and accepted. And just know that in most ICT traders, the first break of structure below in the opposite trend is what is referred to as change of character or market structure shift. So you need to know that after market structure shift, you will see the market reversing all together into deep pullbacks. So as you can see here, it reversed from this point. This one was confirmation that the market is now bearish. So it broke this structure, This was not enough pullback, because an ideal pullback needs to be at least 50% of the whole price leg. So If you mark there 50% is not reached, therefore we don't consider that, and that becomes an inducement, a point of liquidity. Doesn't mean that the market cannot react out of it. It can react and move even aggressively because the market is dynamic. So you just need to put that in mind. So this is an inducement taken, and then we have a break of structure, and then pullback, break of structure, and then the first pullback after the break of structure in the opposite direction is what is referred to as change of character. I marked that wrongly. That should be change of character, because now the market is about to resume its uptrend. So we have a break of structure, pullback, luring more people in, and then we have a break of structure, again pullback, break of structure, pullback, choppy price action, inducement, confusion, and then a break of structure. That is how the market operates. Again a pullback, takes maybe supply and demand somewhere here, pullback, and then it breaks structure again, then it changes character, signaling that now the next trend we are going to have here is an again. Now this is what we are used to be seeing on online. This one does not work in real life. In real life, this is not market structure. This is what market structure entails. So that is one of the major concepts of ICT. And now let's look at another concept. There's another concept here called liquidity. So ICT traders mostly focus on buys and sell side liquidities. You'll hear them talk more about sell side and buy side liquidity. Now, what generally is liquidity? In my previous video of what is SMC and SMC concept, I said that liquidity is just basically where stop losses are and take profits are, entries are, etc. So that basically means that liquidity is just money in the market, where the money is in the market, where the money enters and where the money leaves. It can be buy stops, sell stops, etc. So liquidity refers to areas where many buy or sell orders are placed. In ICT, for ICT traders, they look for liquidity pools where stop losses are likely to be hit, as this area often lead to price reversal or strong price movement. For example, swing highs, lows, trend lines, and around numbers. Now, the commonly used liquidity pool in ICT is called Asian high and low, or session liquidity. For example, this is NZD pair. Let me just use this example. So there's an indicator here called Asian session indicator. You can just look for it. It is free. So it will give you, if I zoom it out like that, you will see them. You will see the colors disappear, and then when it comes back, it appears. So these colors, this fun shows that this is Asian session, this is London session, and then this is New York session. Now, in most occasions, ICT traders target either the lows and highs of a session. Like in this case, if somebody was trading in New York opens here, and as you can see, it has purged the liquidity of the lows or highs of the highs of London session, and therefore they are expecting a price reversal. So they'll wait for maybe a break of structure again, and then they take their fib level, get the entry point somewhere here, and then buy the market upwards. Now, for other people who are also seeing it differently, they'll see that there is highs here of London, and the market is bearish. So upon seeing that there's a purge of liquidity here, it's called raiding stop losses, because so many people stop losses are placed there. Those who entered early or entered during London session, the stop losses are somewhere here, so they're targeting below here. So some who are greedy, who are looking for 1 to 10s, their stop losses are still there, and as you can see, immediately after their stop losses are purged, market reverses. So that is the reasoning of most ICT traders, that when liquidity of session is taken, there is high probability that the market is going to reverse inwards or outwards. Like in this case, this is called buy side liquidity, then this is sell side liquidity. Now, as you can see in this example again, New York's liquidity was purged here and the market plummets again. When you are keen, you'll realize that the following day there were equal lows and highs somewhere there, and then when Asia opened, it purged liquidity and then moved in the opposite direction. Now this liquidity had already been taken, this one had already been taken, and that is why possibly there was no move downwards. So if you follow this market closely, you realize that it was now just in a bullish trend and therefore never purged liquidity. So most probably somebody who waited for this liquidity to be raided took some shots, maybe with other confirmation, took the short, maybe sold here, and then market took them out again, maybe on a break even or something. If you check other example here, let's see other example. Market took liquidity of this Asian session but never moved backwards. So most probably people took losses, and then they repositioned for London and maybe possibly New York. Now if we check other example, two more example. So as you can see, highs of these sessions, this one was raided, somewhere here, and then the market fell again. This one was raided here, the market showed some reversal. So if you mix it with higher time frame buyers, you will know, like in this case, if the market is bullish, you would be most likely waiting for session lows to be taken. If we are bearish, session highs to be taken. That is what they use to combine it with other factors. Like in this case, if the market is projected to go down, London opens and takes the liquidity of Asia, and immediately the market plummeted downwards, which is nice. So that is example of liquidity that most ICT traders prefer to use. So the other thing is order block. Now order blocks basically are areas, so there's a general definition of order blocks, which are areas where large institutional orders have been placed, causing significant price movement. These are typically seen as consolidation zones before a major move. Traders use these order blocks to identify, I'm referring to ICT traders using these blocks to identify potential entry points when price revisit these zones. Now let me give you an example. So order blocks, like let's say there was movement here, so this was an order block, OB order block, price visited it, moved downwards again. There was maybe let's say if you are targeting upwards, there was an order block somewhere here. See, the market moved a little bit, tried to visit it, and then it moved upward. So if you, in most occasions, order block just stacks orders. Like in this case, if you started moving, there's a video I have of order block, so just check. This one was not visited, market pulled back to it but never touched it, used fair value gap, which I'm about to explain. Then there was another order block here. Market used fair value gap, tapped it, because there's even order flow. If you are an SMC trader, you may not just use order block only. Now after market block structure, now order block reverses. So there was, after break of this structure, maybe there was order block here. If you want to know more about specifically order block, check my other videos. There is a video that I'm giving specifically examples of high probability order blocks. There's an order block here. So in most occasions, this one's a single candle order block. Market taps it, reverses, Again, there's a break of structure, so maybe you expect liquidity to be taken first before looking for another order block. There was an order block here, market pulled, took it and went away. In that manner, there was a break of structure here, another break of structure. So possibly, if you're following order flow, this should have been your order block, etc. So if you want a video specifically on order block, check my channel. There are so many videos there of order block. Now the next part is fair value gap that you need to know as an ICT trader. Now, where are fair value gap? Fair value gap comes in the sense of 3 candles. There must be 3 candles like that. So regardless of color, so the distance between the space between the high of the the low or the high of the first candle and that of the third candle, that space in between, this gap is what is referred to as imbalance or fair value gap. Like in this case, we can see that if we check this, you will see that this is the first candle, this is the second candle, the third candle. You will find that there was some space in between. Now this is what is called fair value gap. Now let me look for an example, another example. When price displaces heavily, you can see this is the first candle, this is the second, this is the third. Now check that this space in between this middle candle is what is referred to as fair value gap. You can check my independent video on how to identify high probability fair value gap. So fair value gaps occurs when there is an imbalance or gap in the price action. This gap indicates that the price moved too quickly and the market may return to this level to fill the gap before continuing the original direction. Now another important part of ICT is called optimal trade entry. Now what do I mean by optimal trade entry? OTE as they call it. OTE is specifically a retracement level between 61.8% and 79% fib levels, where ICT traders look for price to pull back before entering a trade in the direction of the prevailing trend. Now this concept is used to identify a low risk entry position. Now if the market is bearish, like in this case we have broken structure in this case, and an ICT trader is expecting that after breaking this structure, let's say they are expecting that the market is going to these examples are just random. If you want them, these are there are specific videos for OTE here. So an ICT trader will wait for, let me give an example. Let's say that the market reversed here, there was a change of character. So if there is a change of character, it means an ICT trader will mark a new price action using maybe order flow and say that we are having a higher high, there's a pullback here, there's a low, and therefore OTE would be from this low, from this high to this low here, and then identify let me use all zones. So let me use the default setting. So an ICT trader will look for trades in fib levels from this point to this point. They look for pullback into 61.8% here and 79, as you can see. So after that they'll place their trade like this. This is the zone, and then maybe cover the lows and take a 1 to 2 or a 1 to 3 depending on what they like. So that is an example of OTE, optimal trade entry. Now again, they see that successfully they have had another break of structure, confirming that we are firmly bullish. So an ICT trader will look for maybe if they are using SMC2, so they'll combine it well and not just use it randomly. So if you take fib level from this point to this point, from this low to this high, from this low to this high, to look for OTE, let's just apply default, you will realize that the market probably never touched the 0.68. Why? Because the ideal market structure, continuation market structure that follows order flow, was this break here, pullback, break above this, pullback, there was a pullback here, from this point here to this point there was a pullback. Therefore the ideal market structure should begin from this point here. This low should not be broken, otherwise it would be bearish. And then from that point now we can look to take from OTE, you can take from 79 and then close the lows, because if this is broken we are bearish, and then target a 1 to 2, a 1 to 3. They mostly target a 1 to 3. So just like two candles and they are done. So that is an example of another OTE. So OTE basically looks for fib levels and therefore taking trades from such fib levels. Now the other concept is liquidity voids. Now liquidity voids, these are price areas where little trading has occurred, often seen as large candles with minimal or no retracement. Price may revisit these areas to fill the void, making them potential targets for traders for trade exit or entry points. Now most ICT traders will use let's say let me give you this example. So ideally, if you look at here, there are so many voids because there is an imbalance here, there is an imbalance here, there is imbalance here. So basically they'll be looking to fill up this this void. So you can see the market came back, fill all of it. Now if you go to higher time frame, if this was 4 hours, if this price leg was 4 hours, ICT traders would be looking to take at least 50% of it before looking to go long again. So that is what is called filling the void. If this was 4 hours bullish price action, it means they would go to 15 minutes and look to take pullbacks up to this level, hopefully, and then before they can get another bullish continuation. Now that is price void, liquidity void. There's another one of equal highs and lows. Now check here. So if you check here, you will realize that there was equal lows here, equals high, sorry. If you check here, there was this some sort of trend line, equal point. Market came, purged them, and then that was not enough, so this one added to it, this one added to it, and therefore market came, raided it, and therefore broke structure downwards. Now again, if you check market closely, you will realize that there was some equal high here, market purged it. So if you check on other time frames, you may see equal points. These equal points are almost liquidity points, like in this case, relatively equal. It means people are stacking orders going upward, and then you can see what the market did. The market totally took all of it and broke structure. So ICT traders look for these particular areas where they can take liquidity, and then before the market can reverse or fully amass them. Another particular concept is Judas swing. Now Judas swing is a new concept, and it is fully coined by ICT trader himself. There is nobody else who coined it. So Judas swing refers to manipulation move in which the market initially moves in one direction to lure traders only to reverse sharply. It is named after Judas Iscariot betrayer, indicating a false move. Identifying this helps ICT traders to avoid false breakout. Now, this Judas swing is coined from the raid of liquidity. You can see market is moving on a downward trend. There was some break of structure here, market pullback, break of structure, but as you can see, it is like the market broke structure again upward here. So it means, according to some people, this is change of character because the market had already fulfilled its movement of closing above this change of character zone. But what happened? Immediately the market reversed inside, meaning that the whole of this is Judas swing. The whole of this price action is Judas swing. It is not real because eventually the market again came because it broke structure. So most of them loaded their orders on this single candle order block and aimed to see market break structure. So anybody who took profit here was lucky, but this is all Judas swings. Thinking that this is now break of structure, this is Judas swing because overall the higher time frame is bearish, and therefore these are just manipulation points, which I said highs of the sessions. So as you can see, eventually the market came down. Now, the commonly used Judas swing is always in between sessions. So in between session, like you can see in this example, the market was very bullish, was very bearish, breaking structure downward. It means some people knew that now the market is going to continue falling, and therefore they placed their sells to continue. What happened? This pushed back. So this is what mostly they refer to as Judas swing. This in between session, this intra session. Another one is this, as you can see, out of session, it came, broke structure, showing that it wants to go upward. What happens? Came back and plummeted. Now, out of session again, there was this move here, causing break of structure, showing that it wants to move down. Then it is now betraying others by moving upward. Now look at this again. In between session, there was this movement here, down movement here, showing that people are on sells, and then the market is now ready to reverse, to come and maybe fill this imbalance here before moving upward. What happens? It moved. Now look at again, out of session, what happened? The market started pulling backward, showing that people are now in sells, and then what happened? Moved upward. So that is how mostly Judas swing operate. Judas swing just lure people to get in and then move out. Now, if you want to see how I combine all this with SMC trading in general, because I use supply and demand, SMC, and unusual ICT trading style, you can check in the description. There is my Telegram group where I give free signals like this, so that people can trade and learn from me too, from what I know.